Hi, thank you so much for joining me. My name is Melissa Berube, and I am a realtor in Morgantown, West Virginia. I'm affiliated with Howard Hanna Premier Properties, and I've been an agent for about 15 years. Started in Florida, was in Western Maryland for a while, manager in Central Pennsylvania, and then I came home to my wonderful hometown of Morgantown, and I've been affiliated with Howard Hanna for about 2 years now. In my 15 years, I've gotten a lot of questions, many from first-time home buyers or possible first-time home buyers wondering what the process is, what the advantages are to owning versus renting. And I used to do several seminars similar to this, but now that we're in the new millennia, I've decided to start doing them as webinars. So hopefully you will find this entertaining and informative as well, and help you maybe make that big decision as far as whether it is good for you to buy or whether you should stay renting. So it's very important to make an educated decision. This is a really big purchase. You know, a lot of people are really afraid to kind of take this leap of faith into making a multi-$100,000 purchase. But it's good to look at the pros and cons as you're going into it to see what's going to, to see if it's something that fits for you. So, of course, there are some cons. There's a lot of responsibility with owning a home. You have to send a bank a mortgage payment every month. That's pretty important. You need to maintain it. There are some upfront expenses affiliated with purchasing a home. Sometimes a down payment rather, is required. Sometimes it isn't. Closing costs, things to that effect. Repairs. Right now, if you're renting and your hot water heater goes out, you simply call your landlord and he comes and he fixes the hot water heater for you. You don't necessarily have to maintain a rental property as you do your own home. You have to clean out your own gutters and you have to mow your own yard and make sure that all the maintenance is taken care of, etc. So there are some of those kind of responsibilities that people hesitate about owning a home. But there are a lot of pros as well. First of all, an investment. One of the biggest advantages of owning your own home is having that stable investment. It is something that yes, you're sending money to the bank every month to pay, but you are building that equity. This is something that is stable for your future. It gives you freedom. Right now you may not be able to paint your child's room in zebra stripes if they want their room painted in zebra stripes, but you can do that in your own house. Mortgage is a very big part of your credit score. So even if you don't have perfect credit, first of all, that doesn't mean you can't get a mortgage necessarily. But paying your mortgage payment on time every month is a very big factor in your credit report. It's actually over 30% of your credit report, so that's a big advantage there. One of the biggest advantages, above and beyond just the investment aspect of it, is the tax breaks. Right now, the federal tax breaks for homeowners is substantial. The amount of money that you pay in your mortgage payment, especially at the beginning of a 30-year mortgage, a majority of that goes to your interest. And all of that is a direct tax deduction at the end of the year, as well as your property taxes. So the property taxes that you pay to the state, those are also direct tax deductions. And we'll get into that a little bit more here in a few minutes. Cash. You're building equity in your home. You're not only paying your mortgage on time, and so therefore you're paying down what you owe on the property, but you're also, property values as a general rule increase over the years. Sometimes they increase more, sometimes they increase less, but you are building equity in this house. So you do have that availability to you if you would have a larger expense, if you would need to go, sending your kids to college, or if you need home improvements or something to that effect. That kind of cash in there kind of really helps you for your future options. It does give you future options. First of all, it's a big investment so that if you are, once you get your family out and you want to downsize, you have that house there that you've been building equity in, that you can turn that into a smaller home, or maybe a smaller home here and a vacation home somewhere else. And it's yours. The pride of having your own home is immense. There is nothing short of maybe bringing your bundle of joy home from the hospital. There's not much that gives you as much pride as knowing that you are pulling into a driveway that you own and you're walking into your very own home. A lot of people are concerned about mortgage rates, and I have this on here so that you can see that mortgage rates, yes, they do fluctuate, but they don't fluctuate all that much. This is a snapshot over the past 10 years. Back in 2008 is when they started dipping a little bit below 6%. You can see in the middle of there, 2012, that's when kind of the recovery from the bubble busting, they really dropped pretty significantly. But even from 2013 to January of 2017, they haven't even really risen over a percentage. They do fluctuate a little bit, but not by very much. And really, if you look at these numbers, a 4% interest rate over 30 years on, a couple $100,000, that is a fantastic return on your money over the years. So you're only paying 4%, and these are fixed. If you get a 30-year fixed, it doesn't matter what the interest rates do in the future, you will stay at that 4.13%. So don't be too afraid of fluctuating mortgage rates, especially if you're looking into a fixed percent mortgage rate. Now, prices are a big thing. We talk about, hear the word appreciation kind of tossed out there quite a bit. So this is a good snapshot. What this is is for Monongalia County only, Monongalia County, West Virginia. This is from sales recorded in the MLS. So in 2012, your average single-family detached home in the MLS was $241,270, and that was 5.4% above what the price was in 2011. In 2013, it went up a little bit, 1.9% to 246.40. Went up just a little bit in 2014, had a nice significant jump in 2015. It appreciated to 6.2% in 2015. So your average single-family home detached dwelling was 264,480. And then finally, last year, this is at the end of the year, you had a 4.3% increase over 2015. So your average sales price for a detached home in 2016 for Mon County was $276,476. And what this shows is over the last 5 years, an appreciation rate. There are no negative numbers. There's one pretty small plus number, but there's no negative numbers. And this really does have a ripple effect. So your average 5-year appreciation rate in Monongalia County is 3.72%. So what does that ripple effect mean? Well, let's say you decided to purchase a house this year and you bought it for the average sales price of 2016. So you bought it for $276,476. Most people stay in their home for, on average, 5 years. It kind of fluctuates. I see different numbers between 5 and 7, but we'll say you're in there for 5 years and then your life changes and you need to move to a different house. Well, what has happened over that 5 years? And this is only if you've just been paying your mortgage payments on time, you haven't, put any improvements into the house or pay down your principal at all. This is simply the appreciation of your house. So what happens from 2017 of a purchase price of $276,476, 5 years later in 2022, oh my gosh, it's going to be 2022 in 5 years. In 2022, you now have a home that is worth $331,872. So for simply living in your house and paying your mortgage payment on time, doing your everyday stuff, washing your whites and cooking your hamburgers, you have built an equity of $55,399. That is a fantastic return for just living your everyday life for 5 years. So that is a significant advantage to purchasing over buying. But let's look at this on a cost of living basis. Let's look at this on an everyday basis. So on your left-hand side, you see a monthly rent of $1,400. Might be a little high for this area, but honestly, it's really kind of hard to find, especially if you're a small family or a young professional. It's kind of hard to find something below $1,200 that's much more than a 2-bedroom, 1-bath townhome to live in. But if you're paying a monthly rent of $1,400, you have zero home value, you have $0 in tax benefit, you have $0 in equity increase. The good news is you have $0 in maintenance, like we talked about the hot water heater before. If your hot water heater breaks, your refrigerator breaks, the landlord or the management company comes over and takes care of it. You are paying utility bills, so we have that added expense. So $1,200 in utility bills. Insurance, you don't have to pay unless you have renter's insurance, but that's pretty mild, and that's not a necessity. Property taxes, you're not paying any property taxes, so that's good. But your total payments, for the year, your monthly payments are $16,800 in rent payments plus the $1,200 in utility bills. So your total cost of living for 1 year is approximately $18,000. Now let's translate this over into if you owned that house. And where that $1,400 comes from that I chose for the rental is because that's approximately what you would pay for a $276,476 house. remember, that was your average sales price for a single-family detached home in 2016. Now you see that monthly mortgage payment only says $1,274. Well, that is because that's your principal and interest payment. The balance of that $1,400 is in your monthly increment payments into your escrow account for your property taxes, your homeowner's insurance. But I wanted to break that down within this column to show mainly the tax deduction that you get. So if you're paying, we'll say $1,400 for your monthly, for your $1,274 for your principal and interest mortgage payment, your home value is $276,476. Your tax deduction in that year, that first year that you own that home, you're paying $11,963 in interest on your mortgage, but that is a direct tax deduction. Now, I am not an accountant, but what that does is that if you, let's say you have a $60,000 gross income, that directly reduces your gross taxable income by $11,963. So that's how that works. You have an equity increase. Remember, you're going to appreciate. So you have an equity increase of $10,285. Maintenance, let's say that hot water heater goes out, $600 you have to pay for a new hot water heater. $2,400 in utility bills. I'm assuming that a $276,000 house, the utility bill is going to be a little bigger, so your utility bills are going to be a little higher. So I put on $2,400. Your insurance, $600. Remember, that's rolled into your monthly payment. Your property taxes are $1,200, but that's part of that tax deduction of $11,963. So that is, so that is actually given back to you. And so your total monthly payments of your principal and interest is $15,288, plus all of your other expenses. Your total cost of living is $8,125. Okay, that is without the appreciation. If you take into account the appreciation, you have made $2,160 just by living in your house for 1 year, paying your mortgage payments on time, and washing your whites and flipping your hamburgers. So that is the best illustration that I can give of the difference between owning and renting. So if you're going to be paying $1,400 a month to live in your house, regardless, you may as well be paying $1,400 a month to live in your own house, building your own credit, building your own portfolio, and making your own investment come true for yourself instead of for your landlord. So that is my webinar. It was a quick recording. When I actually did it live, I didn't hit the right record button, so I had to re-record it. My apologies. If you have any questions, please feel free to email me. My email is melissaberube@howardhanna.com. Or, of course, you can call me. My phone number is right there, 240-727-5830. And keep in mind, I'm licensed in both West Virginia and Pennsylvania, so I am happy to help you with anything that you need. Thanks so much for bearing with me. Take care.